everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 387 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to be talking about some rules. And I know, I've talked very recently about how sometimes the rules need to be thrown out the window, but I specifically want to be talking about rules of investing in the stock market right now, and exactly what you should be thinking about when it comes to your investing life today. And this is something that I'm sharing with you from Josh Brown. And Josh Brown, he's the CEO of Ritholtz Wealth Management, has several podcasts. What are your thoughts? And he has, the Compound and Friends, and but he has this blog called The Reformed Broker, and he posted this blog post at the end of last week, and I thought it was really interesting. I think it's going to be really useful for you guys, and so I'm going to share a lot of his thoughts, a lot of his principles, and things that I completely agree with in today's episode. So stick around for a discussion of all that and more today. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So I talked yesterday a lot about movement in tech stocks, and that movement being down recently, right? And so I just want to share with you guys things that I think you can do, or things that I think you shouldn't do, or how you should think about investing in these markets that we're in right now. So again, I'm going to share you something that I read from Josh Brown. If you've seen him on CNBC, he's fantastic. Right? But these are a lot of his thoughts mixed in with a lot of mine, so I'll just jump right into it. So the Nasdaq Composite is now undergoing its 66th correction since its inception in the year 1971. So a correction is a drawdown of greater than 10% from a high. So the Nasdaq has seen 66 10% or more drops since 1971. Now, it's up way higher than anyone would have ever expected since 1971. Now, in this case, the Nasdaq peaked the week before Thanksgiving and is now almost 15% lower. The question on everyone's mind after last week's disgusting close is whether or not the correction will turn into a full-blown bear market, meaning the drawdown being 20% or worse from the high. Mark DeCambry wrote about the historical probabilities of this happening at Market Watch last week. According to Dow Jones data, during 24 of the previous 65 times the Nasdaq has corrected, a bear market has followed. So that's 37% of the time. But in 41 instances, or 2/3 of the time, the Nasdaq Composite's correction did not turn into a full-blown bear market, and the correction represented a swiftly rewarded buying opportunity. Right, so I talked yesterday about not selling and looking at this as a buying opportunity. Well, even bear markets are buying opportunities. They're just much more uncomfortable buying opportunities, right? But this could very easily be a buying opportunity that you don't want to miss, and that if you did miss, you would look back later and go, dang, why was I not putting money to work then? Now, our best guess is that we will go past the 20% threshold into a bear market. We're at 15%. The S&P 500 hasn't even gone into correction mode yet. So if that happens, then watching the Nasdaq go into bear territory would not be that surprising, right? But in a 14 and change percent drawdown already, that extra 6% or 5% won't make much of a difference at this point, right? And you should know that we've been here before. Right? The Nasdaq has had some absolutely huge drawdowns even in recent years. So if you just look back, obviously in 2020, Nasdaq drew down over 30%. You go back to late 2018, Nasdaq drew down 20%. You go back to 2016, Nasdaq drew down over 15%, right? Earlier in 2015, Nasdaq drew down under 10% back to back, right? You go to 2013, 2012, right? The Nasdaq has had some very big drops, and so this is nothing new. Now, this one's bad, but not the worst, right? At least not yet. And you can also add that an enormous percentage of the composite stocks have already been in bear markets of their own for quite some time, right? Again, some of those names that I've talked about already, you go back and you say, okay, let's look at Peloton, right? Well, Peloton, from its high, where are we sitting now? I mean, as of the end of last week, I know that you're already looking at more than 80% down. So that's just a huge drop, right? Netflix is in bear market territory, right? All these companies that you know and love, or maybe you don't love them so much anymore from an investing perspective, are down quite a bit. Now, there's also a list of Nasdaq stocks that have already been cut in half from their highs over the last year, right? This includes a lot of meme stocks, IPOs, SPACs, biotechs, electric vehicles, right? Alternative energy, all these different types of companies, right? And so what's different now is that the largest names in the NASDAQ are starting to get sold, right? Netflix, Amazon, Alphabet, Facebook, Apple, Nvidia, right? They are catching down with the rest of the stocks in the market now. They are also falling. So if you look to the end of last week, right, you go from January 14th to January 21 close, right? Apple is down 6.13% in just that week's time. Microsoft 4.61%, Alphabet 6.62%, Amazon 12.03%, Nvidia 13.16%, Netflix 24.49%, right? All of these companies are down quite substantially, right? And again, we may not be done yet. But I want you to think about all this from a realistic historical perspective, right? If you look back from 1928 to 2021, and you look at what's the frequency of market drops of different magnitudes, right? 5%, 10%, 20, 30, 40, or worse, right? You would say, how often do these happen throughout these years? Well, 5% or worse occurs in 95% of the years in the S&P 500, right? 95% of the years have a 5% or worse drop. So we've already had one this year. So hooray, we are part of that 95+%. What about 10% or worse, right? 63% of years have a 10% or worse drop. So that means over half the time, nearly 2/3 of the time, there's going to be a 10% drop in the S&P 500 in a year. So we're coming closer and closer to that. And so if that were to occur, again, we shouldn't be surprised. Now, what about the big hitters, right? What about the ones that really hurt? 20% or worse happens 26% of the time, okay? What about 30% or worse? Happens 10% of the time. So 1 out of every 10 years, the market will drop 30% or more. And then what about 40% or worse? Only 5% of the time, okay? Now, these averages are a little skewed higher because of the crashes in the 1930s, right? That gives you more of these big down years. But even in modern times, stock market losses are a regular occurrence. Since 1950, the S&P 500 has had an average drawdown of 13.6% over the course of a calendar year, which is right there in what the averages say with those statistics I just gave you. Over this 72-year period, there have been 36 double-digit corrections, 10 bear markets, and 6 crashes, right? Crash being 30% plus. So a correction once every 2 years, a bear market once every 7 years, and a crash once every 12 years, right? These things don't occur on some set schedule, but they do occur, right? So again, so far the S&P 500 isn't even there yet, but the Nasdaq is leading, and the Nasdaq has been heading further and further down. So what do we do, right? What do you do? What do I do? How should we think about investing in this type of environment, right? These are the things that Josh Brown sets forth, and I agree. I agree with what he's saying here, and we should go through our investing life and our investing psychology and investor behavior in this way through this downturn that we're currently having, okay? So the first thing that he says to do, and he uses a choice word, but I'm going to just keep it PG here, and I'm going to just say, shut up, right? Shut up. No one wants to hear you complain about having stocks that are down, right? They also have stocks that are down. Nobody wants to add insult to injury. Now, commiserating with humor is allowed. Memes about losses are great, and everyone can relate, right? But here's the deal. Everyone has stocks that are down at all times, right? If you all own individual stocks, or even if you own an index, there are always stocks in the index that are down at all times, right? Nobody wants to hear about it. And at a time like this, everyone has stocks that are down big, and it can absolutely hurt. You may be hurting right now because you have stocks that are down big, right? And if they don't, they're not really investors. I'm telling you right now, I have stocks that are down big. I have ETFs that are down big, right? So if you don't right now, you're not a real investor in the market. You're not a player in the market. And those who don't have anything that's down big, they're just playing make-believe on social media. They may just be lying to you. You don't know, right? People are especially irritable when stocks are falling and brokerage account values are declining, right? Try not to get on everyone's nerves. Don't beat your chest for having taken money off the table. Don't told you so your friends. Just grit your teeth and get through it. Say less, okay? You hear young people now saying, man, say less. Different meaning here, but just don't say so much, right? Don't say so much about the market dropping. We all know that it is. We all know what is going on. So just don't add insult to injury. Don't rub it in people's faces. Don't rub it in that your stocks haven't gone down as much as theirs. Don't rub it in that maybe you got out before whatever, right? That's, even though it may work for you once, doesn't mean it was the smart thing to do in the first place, right? And that's something we have to learn about the market. And the reason that we have to just shut up about our investment performance in general is that just because you've done something well in the short term doesn't mean it's always going to work. Quite the contrary, actually. Most of the time, it means it won't work the next time around, okay? So yes, the first rule that he has for us is shut up, okay? The second thing is comportment, okay? Now, this is a word that it's a great word, but it's not very commonly used in the English language, especially by Americans, right? Maybe at boarding schools in the Northeast they use it, but it's not, a word that's very commonly used. The art of comporting oneself in the face of adversity, right? Basically means act like an adult, right? Go about your business. You have no control over the markets will do, only your own reactions. And man, does every investor need to learn this lesson? Every investor needs to learn this lesson to control what you can control, okay? Act like an adult. Act like you've been there before, even if you haven't, okay? Don't whine and cry to influencers on TikTok or Instagram or Twitter or Reddit. Don't blame Jim Cramer for your decisions, right? Ultimately, you have made your investment decisions. Other people may have given you advice, but you make the decisions, right? So don't cry about it, right? Don't be, sad and think that somebody's out to get you or that the market's out to get you or whatever, right? Put your head down, act like an adult, control what you can control. And one of the things that you can control, obviously, is the actions that you take in the market, the buying or the selling that you do, right? That is something that you can control. You can control whether you click that button and sell that stock or sell that ETF or whatever. You can control whether you click that button and you buy something. And now may be the time. Now may be the time to put money to work, right? But you have to understand that just because it hurts, just because it's something that is negative that's occurring, does not mean that it gives you the license to go through life going, oh, feel bad for me. Everybody's out to get me. The market's out to get me, because it absolutely is not, right? Now, comporting yourself in this way is going to become a very valuable ability as you get older and the assets and dependents you're responsible for grow, right? A lot is going to be riding on your comportment during some of the worst times, right? Your sons and daughters will be watching how you act, comport accordingly, right? So we need to act like we've been there before. We need to act like adults. We need to go about our business, and we need to pass down this idea of controlling what you can control, of doing what you can to get through a situation, but otherwise taking things on the chin and just moving on, continuing to move forward as things may still go awry, right? And that's what we need to be doing in today's stock market. Now, the third rule that Josh Brown leaves for us, I think, is really interesting. It's his own psychological trick. And what he does is this. He says, put in some absolutely absurd, good till canceled, buy limit orders on stock that you've always wished that you owned, right? At prices so far below their highs that it would be miraculous for them to ever get down there for you to buy at that price again, right? So I think this is interesting, right? So first of all, when you put in a buy order, You can choose to do it at market, right? You can do a market order, or you can do limit orders, right? And limit orders basically mean if it passes this threshold of price, then purchase, right? Then purchase these shares, right? And good till canceled means what it says, right? They are good. Those orders are still good until you cancel those orders. So if you put them in, he's saying just find stocks that you've liked that have been expensive in the past, and you're like, I like them at a certain price, but those prices are way lower than what they are currently or have been recently, right? But now may be a time to go way below the current prices or way below their highs and set up some good till canceled limit orders where you could get really high quality, good companies at very low prices. And they may not all get filled, but it may be beneficial to you because you might pick up a few. Now, make sure there's enough cash in your account to cover these orders should you get hit on a few of them, right? If you actually have to come up with the cash to do this, then make sure that you have the cash, right? Now, this is a great trick for surviving corrections, especially if you're buying individual stocks. Again, if you're not buying individual stocks, then this may not be something that's super useful for you. But what you still could do, right? You could do this with ETFs, right? You could do this with ETFs, and maybe don't go so far below a price on an ETF in the same way you would with a stock. But this could provide you with some of that downside buying that could be really valuable to you and make you feel better about your investing, right? Josh Brown said that this always works for him, right? He starts subconsciously rooting for sell-offs to get hit on by, the buy limits for the best stocks in the market. And sometimes he actually gets them, right? He bought Starbucks in the 60s in spring of 2020. It subsequently ran to 120. He didn't know that it would ever get down to the 60s. He just knew that if it did, he wanted to own it there. And then one morning it gets filled, boom. And he said now he's currently setting up bids at ridiculously low prices for a handful of names, all limit orders at good till canceled, right? And then you just see what happens. So I think this is an interesting psychological trick. It can keep you on the buying end of things and not the selling end of things. And if your orders don't fill, then no harm, no foul, right? Nothing wrong. That means prices stayed high enough that things were still good. But if your orders do get filled, then yes, the stock market went down quite a bit, or that stock went down quite a bit, but you were able to benefit from it by getting something on sale. I think that's a great trick. Now, the fourth rule that he has is remembering that it's not about you and your regrets and the fact that the last 3 stocks you bought went straight down, right? Don't be in people's mentions asking about individual names, right? Like, so do you like this Cisco? I mean, come on, every stock is down. It's not about that. In a stock market-wide correction, right, with the VIX, the volatility index, headed towards 30, it doesn't matter what people liked before or why they liked it. Stocks temporarily become commodities as funds and traders sell what they can when they can to meet redemptions or reorganize themselves for the eventual rebound or make margin calls. Indiscriminate selling is a good thing, right? It means we could be getting close to the end. So try to remember that it isn't about you and your problems. It's bigger than that. The market isn't watching you. Your actions and emotions are not a signal of anything, right? Again, controlling what you can control, understanding that you have limited power in this market. So just take what you can, do what you can, be effective where you can, but you can only do so much, right? And the market is bigger than you, and the market's going to do what it decides to do, and you buying or selling is not going to change that. Right? So we have to remember this, especially in the face of individual stock investing, right? And that's why I say it's not for everyone, because you can buy things at good prices and they still go straight down in the short term, right? But it's about conviction. It's more of an art than a science at times, and this would be one of those times when it is quite a bit more an art than a science. So just remember that this is not about you, right? It's not some personal vendetta against you. It's just something that occurs, okay? Now, the fifth thing he has for us is that newer companies have less long-term institutional support, and as such, they will be absolutely thrashed. Now, this isn't true in every single case under the sun, but it is mostly true. He said he'd bet if someone ran the numbers, they'd find what he's already learned, and so he just knows this intuitively. The most recently public stocks are going to get sold off the hardest. So the ones that have come public most recently. And if it's a smaller, recently public company, well, lights out, right? It's just an unavoidable risk that you're assuming when playing in these names. So take a look at his beloved Matterport, right? Which is a stock that's had zero news come out over the last 30 days and has still managed to get cut in half, right? Small company. And then if you compare it to the small cap growth ETF from Vanguard that I was talking to you about, the VBK, right? I was talking about that yesterday, down 9.31% in a month. But look at the returns on Matterport in that same time, down 47.55%. Very staunch difference based on the type of company it is. He's showing it versus this ETF, because that's basically its peer group. But stocks have to be around long enough to be included in that index. And this company is just months old as a public company and isn't in any substantial indexes just yet. So he says he's in this stock and it sucks because prior to this correction, it was doing incredibly well. But he's now given up all his gains and has unrealized losses, and it happened virtually overnight. This sort of thing doesn't happen with more established, longer tenured stocks. And so for all the reasons discussed, it has been orphaned. He said he's sticking with it as an investment. It was never a trade, but he's also not happy about it. So outside of this, however, you won't hear him griping and moaning about it, right? It won't be the first bag he ever held, and it won't be the last, right? So we have to, again, take some things with a grain of salt. Understand that if you're trying to buy newer companies, smaller, newer companies, then you may take it on the chin, okay? Now, what about number 6? Remind yourself that unless you're in your 70s, chances are you're still a forced buyer of stocks for the time being, right? Retirement investing requires that you accumulate assets that have the potential to out-earn the longer-term inflation situation. And at today's yields, bonds and cash just can't do so. So we are going to be forced buyers of stocks over a long period of time via our 401ks, 403bs, whatever, our IRAs, whatever we're using, right? We're going to be forced buyers of stocks. And so regardless of what's going on, you still are going to be buying. You're going to be buying at these lower prices, which is going to be beneficial for you, right? It's going to be beneficial for you to do this. And so even if you're in your 50s or whatever, right, you still have a long time that you're going to have to keep up with and beat inflation just in order to keep the value of your money where it is, right? So as you continue to earn and put money away, you'll be buying equities with some of your savings, right? The younger you are, the more this is an absolute, right? No choice. Your 401k demands it of you, right? And you should be doing this. You should be investing systematically over a long period of time. That is the way to win. So we're going to be forced buyers of stocks. And so if that's what you're doing, then you're constantly buying at lower prices as the market drops, which is a good thing, right? Now, the 7th thing that he has for us is find something else to focus on. So if you've committed to riding this out rather than panicking, that's a good thing, right? You make the right choice. I've told you, we don't just want to be relegated to panic selling. Now what, right? Well, now you want to make life easier to deal with. And especially if you're not buying or selling in individual names and you're just an index investor, you just invest in your IRA or 401k, which is perfectly fine, right? Especially if you're there, right? Forget the market. Don't worry about it for a while. Find something else to focus on, right? Shut off the news alerts on your phone, right? Close your laptop, stop checking prices, log out of, Robinhood or whatever else, right? You're not doing yourself any good by watching tick by tick. And that's especially if you are an individual investor, right? If the TV's on, remember, everyone you see on there is doing their best, but they're also making guesses. No one can know what's going to happen for certain, and we're pretty certain of that. We're pretty certain that nobody's going to know what happens for certain, right? So do things that are going to, just clear your mind of financial markets for some time, and then come back later, and you're probably going to find something that's going to be pretty awesome, and that's that the value of assets continues to go up over time, and you are going to make money as long as you keep buying. Then number 8, don't cap your upside at the bottom, right? There are going to be people out there selling hedging solutions against losses now that everyone's just experienced losses, right? This works every time. If you had only listened to them before, right? Christmas would have been saved. I'm not anti-hedging. Just know that the more you try to suppress risk, the more you're sacrificing potential return, right? We know there's a positive risk return correlation, right? So what do you want to do now, right? Calculate the perfect amount of equity risk to take in the first place rather than taking too much and then trying to hedge some of it away, right? Know how much you need to have in equities and then just stick to that, right? We don't need to, take less risk now that we have already taken on the risk, right? You've already taken it on. Whatever risk you were taking pre-drop, you have taken it, right? And you've taken losses because of it, right? Now you don't want to take less risk from the bottom. If anything, right? And I'm saying risk as, volatility, right? If anything, it might be more beneficial to do the opposite. Take more risk from the bottom, take more volatility from the bottom because you may get higher returns from the bottom, right? But that's a may get higher returns from the bottom. But if you cap your risk, you decrease risk at the bottom, then you're assured to at least bounce back slower than you would have otherwise. Now, the ninth thing that Josh Brown has for us is that swinging to cash is crazy, right? Swinging to cash is absolutely crazy. And I'll say it one more time. Swinging to cash is crazy. Okay, even if it works once, it's not going to work twice. You can't do this reliably. No one has ever demonstrated the ability to be all out and then all in and all out again, right? Turning themselves into a massive loss. It's simply not possible, right? That's what you think you're going to do, then think about the implications of this mindset. You're basically saying you have the magical ability to predict what 100 million other investors are going to do, when they're going to start selling, and then when they'll stop. Around the world, it's beyond farce, right? You have to stop believing in magic. So just don't sell. Don't go to cash when things go bad. If things go bad, then guess what? You're probably going to get caught in the middle of it. When the market drops, you're going to get caught in the middle of it. And that's okay. Again, they're buying opportunities, and over long periods of time, you're going to be better off sticking in the market than you're going to be trying to get in and get out. Market timing does not work, right? I've said it many times on this show. It's not about timing the market. It's about time in the market. Stay in the market, continue buying. You will be better off because of it. Then his 10th rule for us, Josh Brown's 10th rule for us, is that the basics still work. Diversification. A year ago, you may have been tempted to go all growth, lose the value, and load up on momentum names that everyone loved. DraftKings, Tesla, Moderna, you know all of them, right? The stuff that wasn't hot then, energy, utilities, REITs, banks, right? That's what's saving you right now. Bonds too. You know what else was a good decision? When your wealth manager at the wirehouse called you to pitch $1 million portfolio loan for general purposes against your brokerage account, you said, no thanks, I don't need the cash right now, right? Then he said, well, we should just set it up in case you ever want to use it. You got to unlock both sides of your balance sheet. And you were like, seriously, I'm good. Call the next schmuck on the opportunity list they handed you. So if you did that, you're fine now, right? Keeping leverage low is working. You can sit tight. Nobody's making you do anything now. There's going to be a big opportunity to rebalance out of fixed income into stocks the longer this keeps up, right? Rebalancing opportunistically into a correction is great. You can do it and do tax loss harvesting as well. That's something else that can be beneficial on the other side of correction. All these types of things, right? The basics still work. The things that are fundamental that I may have taught you on this show over the past few years, investing wise, that you may have gone, man, this guy doesn't know what he's talking about, right? Tesla's up this many percent, or Bitcoin's up this many percent, or whatever, right? He doesn't know what he's saying. But now you may be looking and go, well, maybe these things work, right? Maybe him talking about Graham and Dodd is right. Maybe diversification is right. Maybe asset allocation is right. I'm not saying I'm right all the time, and I'm not saying it's easy to control my own investing behaviors. But what I am saying is, and agreeing with Josh Brown here, the basics still work. So hopefully these are things that you can take with you and that you can benefit from in your investing life as you move forward. I want you to be successful investing, and the best investors are made in these down times. It is best to learn from. It's best to benefit from, buy from, and you just have to know where we've been, because there's no way to know exactly where we're going, but we can have a general idea based on history, and history is a very good guide in the stock market and can put you at ease if you actually know what the benefits are to getting invested, staying invested, and not griping about it and not thinking that you can do anything to change the minds of hundreds of millions of others. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.